Assalamu alaikum. This is Javiya Sajed, and today we are going to discuss the topic of the cost of production from managerial economics. Okay, let's move on to the slides. As you can see in the first slide, we will describe what economic cost is. As the definition suggests, the measure of the economic cost or opportunity cost or any resource used to produce a good is the value or worth the resource would have in its best alternative use. In simpler words, economic cost is combination of losses of any good that have a value attached to them by any one individual. It includes opportunity cost when analyzing economic decision, like for example of opportunity cost of attending college. Okay, let's move on to the next slide. Explicit versus implicit cost. What are explicit cost? Explicit cost is direct payment made to others in the course of running a business, such as wages, rent, materials, etc. And as the definition suggests, it makes to those who supply labor services, materials, fuel, transportation services, and so on. For the implicit cost, it is where no actual payment is made. Any other cost that has already occurred but not necessarily shown or reported as a separate expense. It represents it is represented as an opportunity cost that arises when a company uses internal resources towards a project without any explicit compensation for utilization of resources. As well, you can see the definition to the four implicit costs are the money payments that self-employed resources could have earned in their best alternative way. Okay, now what is economic profit? As or in simpler words, you can see in the slide as well, it is a firm's total revenue exceeds all its economic costs, explicit, implicit, any residual goes to the entrepreneur. That residual is called an economic or pure profit. Its formula is economic cost is equals to total revenue minus economic cost. In simpler words, profit or loss difference between the revenue received from the sale of an output and the cost of all input used as well as opportunity cost. It include economic profit, opportunity cost, and explicit cost are deducted from revenue earned. Sorry. In calculation, economic profit, opportunity cost, and explicit cost are deducted from revenue earned. Okay, by elaborating further, the economic profit, I can give you an example. That is, let's think economic profit is the profit from producing goods and services while factoring in the alternative uses of a company resources. For example, the implicit cost could be the market price a company could sell a natural resource for versus using that resource. A paper company owns a forest of trees. Okay, let's move on to the next slide. That is law of diminishing returns. What is law of diminishing returns? It is also called law of diminishing or marginal utility, marginal productivity. Economic law is standing or stating that if one input in the production of commodity is increased while all other inputs are held fixed, a point will eventually be reached at which additions of the input yield. Example of marginal or diminishing marginal productivity is a worker may produce 100 units per hour for 40 hours. In the 41th hour, the output of the worker may drop to 90 units per hour. This is known as diminishing returns because the output has started to decrease or diminish. Instead, output is not increasing at such a high rate or previously as it was increasing. Moving on to the next concept, that is fixed cost and variable cost. As you can see in the definition, fixed costs are those costs that in total do not vary with changes in output. Fixed costs are associated with the very extensive existence of a firm's plant and therefore must be paid even if its output is zero. whereas variable costs are those costs that change with the level of output or that change with the level of production demand. They include payments for material, fuel, power, transportation, service, most labor, and similar variables resources. Like if your requirement is increased or demand is increased, variable cost will increase because the units you require for the end product will increase. Okay, next is total cost. Total cost is very easy, which we get from combining or from or through the sum of fixed cost and variable cost. Okay, you can see the calculations are basically made for total fixed cost, total variable cost, total cost, average fixed cost, average variable cost, average total cost, and marginal cost. Okay, you can get the total cost by joining or by taking a sum of total fixed cost and total variable cost. If you want to calculate total average fixed cost, you can divide total fixed cost with quantity. If you want to calculate average variable cost, you can divide total variable cost with quantity. If you want to calculate average total cost, you can divide total cost with quantity. And if you want to calculate marginal cost, you can divide change in total cost with change in quantity. That is how you can get your results. It's not such a rocket science, it's very easy, and you can go through the calculations or the index of the table I have input in the slides. It's very easy, you can calculate at your own. Okay, moving for the other topic, that is per unit or average cost. Okay, average cost per unit of production is equal to total cost of production divided by the number of units produced. It is also known as the unit cost. Specifically, over the long term, average cost normalizes the cost per unit of production. The average cost per unit is the estimated total cost, including allocated overhead, to produce a batch of goods divided by the total number of units produced. It is equal to the total cost of production divided by the number of units produced, also known as the unit cost. By moving further, marginal cost. What is marginal cost? Marginal cost basically is change in total cost divided by change in total quantity. Marginal cost refers to the increase or decrease in the cost of producing one more unit or serving one more customer. It is often calculated when enough items have been produced to cover the fixed cost and production is at a break-even point, where the only expenses going forward are variable or direct cost. Marginal cost refers to the additional cost to produce each additional unit. Like for example, it may cost $10 to make 10 coupons of coffee. To make another would cost $0.80. Therefore, that is the marginal cost, the additional cost to produce one extra unit of output. Fixed cost can also contribute. As you can see in the graph, which is the relationship of the marginal cost curve to the average total cost and average variable cost curve, it suggests that you can see the marginal cost is touching or hitting, or you can see that is overlapping average total cost and average variable cost. So what does it interpret? It interprets that if marginal cost is below average total cost, so average total cost falls, whereas if marginal cost is above average total cost, here average total cost rises. For the same, if marginal cost is below average variable cost, in this scenario average variable cost falls. Vice versa, if marginal cost is above average variable cost, then average variable cost rises. So this is the interpretation and total interpretation of this graph. By moving forward, we will discuss the long run production costs. So what are the long run production costs? Long run costs are accumulated when firms change production levels over time in response to expected economic profits or losses. In the long run, there are no fixed factors of production like the land, labor, capital goods, and entrepreneurship are all vary to reach the long run cost of producing a good or service. As you can see in the chart, the long run average total cost curve, 5 possible plant sizes are available. What does this interpret? It interprets that long run cost curve is made of many small segments of short run cost curve, like here ATC 1, ATC 2, ATC 3, ATC 4, and ATC 5. Now we are moving to the last topic of our slides, that is economies and diseconomies of scale. What are economies and diseconomies of scale? Economies of scales are when the cost per unit of production, which is average cost, decreases because the output increases, whereas diseconomies of scale are when the cost per unit of production, average cost, increases because the output increases. Growth brings both advantages and disadvantages to a business. This is a fact. Economies and diseconomies of scales refers to these reduced costs per unit arising due to an increasing in the total output. This is what? This is economies of scale. I am repeating again. Economies of scale refers to these reduced costs per unit arising due to an increase in the total output, whereas diseconomies of scale, on the other hand, occurs when the output increases to such a great extent that the cost per unit starts increasing. Okay, so these are the overall concepts I have conveyed to you. I hope you guys will understand what I'm trying to convey and will like my lecture or the way I am explaining. Thank you for your time. Have a nice day. Allah Hafiz. Assalamu alaikum.